Namaste, good morning, friends. So, fresh morning, fresh topic. Okay, a topic which can have a standalone question or a question like how we worked yesterday, where as a part of the main question there will be adjustments like land being transferred, etc., etc. Okay, it can be both ways. It can be a separate question or standalone question, okay, or it can be part of a larger question. But capital gains should carry somewhere around maximum of 10 marks, minimum of 4 marks. Okay, that should be the entire importance of it. Okay. In your notebooks, how to compute capital gains. In your notebooks, how to compute capital gains. Okay, right? How to compute capital gains. Okay. So the chapter we are entering is capital gains. Okay. The question we are answering is how to compute capital gains. Okay. Full value of consideration. Okay. We are computing full value of consideration less, okay, cost of transfer will lead me to net consideration, okay, okay, less, okay, cost of acquisition in the case of short term, indexed cost of acquisition in the case of long term assets, okay, cost of improvement in the case of short term, indexed cost of improvement in the case of long term assets. So if I take this to the outer column, okay, the final answer, the answer at this level I will get is gross STCG or LTCG. I am writing the positive amount. It can also be STCL or LTCL. It can also be LTCL or STCL. Okay, okay, that is my gross STCG or LTCG. Okay, exemptions 54 slash 54B slash 54EC, actually 54D, sorry. Oh, okay, 54EC slash 54EF. Okay, these are majorly I can say for non-business associates. Though 54 EC can be claimed by everyone. Okay, I no doubt say 54 EC can be claimed by everyone, but 54, 54B, 54F. Okay, so except 54 EC, others are restricted to individuals and HUF. Except 54 EC, others are restricted only to individuals and HUF. 54 EC, everybody can claim. In this, the interesting aspect is 54B. Okay, this alone is available also for STCG. I have put it in a different color pen just to highlight and tell you that this alone is available also for STCG. 54B alone is available also for, that is for agricultural land transfer. That alone is available also for STCG, whereas 54, 54EC and 54F is restricted to LTCG. 54D, 54G, 54GA. These are only for PGBP, okay, both STCA and LTCA, okay, these are only 54D, shifting of, 54D, compulsory acquisition of industrial undertaking, I get another land and building, 54G shifting, 54GA shifting to SEZ, okay, these are also available for STCA because majority are depreciable asset in that. So it is also available for STCA with one ground rule which the class should understand, that if there is both the LTCG and the STCG, first to provide for STCG because STCG is taxable at a higher rate whereas LTCG is taxable at a lesser rate. There is a third category of exemption, okay, which is 54GB, which is 54GB. It's a combo, okay, sale of HP and investment in business, okay. So it's a combo. So in this case, it is a combo. So I can divide the exemptions into three. This is also 54GB is also for individuals only, but the investment is not in a domestic asset. The investment is in the business. Okay. So again, this is available only for LTCG. Okay, and it's only for individuals. Okay, so this is how the exemption provisions work. 54, sale of house property, purchase of house property, sale of agriculture land, purchase of agriculture land, sale of any long-term asset, purchase of specified asset, sale of any asset other than house property, purchase of house property. Sale of house property and investment, these are available only for individuals and HUF except 54EC, which is available for everyone. These are not individuals, not HUF. No, I'm just saying whoever carries on business or profession. It can be company, it can be sole proprietor, it can be firm, anybody, whoever carries on business or profession. Okay, 54D, 54G, and 54GA. These are all the exemptions which will take us to taxable STCG or LTCG. Because at this level, you will provide exemption only if there is income. Okay, otherwise there is no exemption. So after that, it can only result in taxable or zero. It cannot be negative. Is clear. Certain things are needless to explain. Okay, what is a capital asset other than stock in trade, movable personal assets other than jewelry, work of art, architecture and painting, rural agricultural land. These are not capital assets. There is not going to be any capital gain on this. There is not going to be any capital gain. Transfer includes everything. Transfer does not include, okay? Transfer does not include where it is, sorry. Transfer does not include in the case of companies, liquidation, amalgamation, holding subsidiary, 100% subsidiary, vice versa, provided the transferee is an Indian company, demerger. Okay, so in our PGBP chapter, wherever we will take the cost of the previous owner, all those cases are not going to be considered. Gift or inheritance, okay, all these things will not be considered as where we will record the value of the WDV of the previous owner. That's what I meant. Okay, all these cases will not be regarded as transfer, member transferring to HUF, HUF transferring to member. So safely answer those things. You be 100% sure that those transactions will not be regarded as transfer. Those transactions will not be regarded as transfer. Do not give, do not spend so much time on that. Okay, right. Then if we come to classification, classification is two-way depending upon the holding period. In the case of listed shares, equity oriented funds, okay, less than 12 months is short term. Okay, more than 12 months is long term. Okay, and in the case of immovable property, unlisted shares, less than 24 months. In any other case, less than 36 months is short term. If it is not a short term, it is a long term. Why do we need this split? Because of two things. One, the benefit of indexation. Two, the benefit of taxation. So indexation is applicable only for Indexation is applicable only for long-term capital asset. Okay, right? Now we will have a quick note on indexation. We will have a quick note on indexation. Okay, the formula says cost of acquisition into CII of the year of transfer divided by CII of the year in which asset was first held by the assessee. Okay, the formula says COA into numerator CII of the year of transfer, denominator CII in the year in which asset was first held by the assessee. Put it more clear, okay, normally numerator will be 289, that is for FY 1920. Let's come to our year and understand. Normally FY 1920, okay, right? In the following cases, transfer will be different year and taxation will be in a different year. Okay, right? In the following cases, numerator might not be 289, though I am taxing it in financial year 1920. Though I am taxing it means computing the capital gains in the financial year 1920, but the numerator strictly need not be 289 because the transfer has already taken place, whereas only the computation or taxation is deferred. Only the computation or taxation is deferred. The transfer has already taken place. In those cases only, it will be different. What are all the cases? Okay. Extinguishment of asset. That is destroyal of an asset. Okay. Year of destroyal is numerator. Okay, computation in the year of receipt of insurance compensation. Okay, extinguishment of asset, year of destroyal will become the numerator. The computation is deferred to the year in which I am receiving compensation. Compulsory acquisition. Okay, compulsory acquisition. Okay, year of compulsory acquisition is the numerator. Okay, computation in the year in which compensation is first received. Okay, compensation is first received. Okay, conversion of asset into stock in trade. Okay, year of conversion is numerator. Okay, Computation in the year in which stock is sold. Okay, computation is deferred to the year in which I am selling the stock. I am selling the stock. Okay, next, the last one, the fourth one is specified agreement. Specified agreement. What is a specified agreement? Where the landowner enters into a joint development agreement. The landowner enters into a joint development agreement with the builder. Okay, the landowner enters with a joint development agreement with the builder where he transfers the land and building. Okay, it is known as specified agreement. It is known as a specified agreement. Okay, right? Year of transfer of land and building will be the numerator. Computation is in the year in which the builder, okay, completes the construction and hands over the possession. Okay, in the four cases, the numerator will not be 289. In four cases, the numerator will not be 289. If any of these cases are there, look for the numerator. In our institute question, we have an advantage. In the bracket under that, they are giving the CII. They will give for 3 years. Normally, they should give for 2 years. They will give for 3 years. Okay, that itself is a triggering point to you. Okay, the விஷயம் okay, so be sure that it will be very clearly given to you that because that reminds me, please have your CIIs along with you when we are working the practical questions. Okay, so so these are all the numerator and denominator. These are all the cases where numerator will not be 289. It will be some other year. Now coming to the denominator. Okay, cost of acquisition. Okay, indexation for COA. Okay, cost of acquisition will have the year of acquisition or will have the year of acquisition or 100 as denominator. Okay, as a denominator, if it is before 1/4/2001, I will have it as 100. If it is before 1/4/2001, otherwise the year in which I acquired will be the denominator. Okay, exceptions, gift or inheritance. Okay, gift or inheritance, denominator as per law will be the year of receiving the gift or inheriting the asset. Gift or inheritance as per law, strictly going as per law, will be year of gift or inheritance or year of gift or inheritance. Okay, okay. Debentures converted into shares and shares sold, denominator will be year of conversion. Okay, right? These two cases apart from 100, asset purchased before 1/4/2001, these two cases denominator will change. Here we have the Manjula Desha case where it is said that if when you take the cost of the previous owner, when you consider the other aspects of the previous owner, that is the holding period of the previous owner, consider the indexation also. It is not a Supreme Court judgment, it is only Mumbai High Court judgment. So we will work two ways in all the questions which involve cost of the previous owner. And when I say gift or inheritance, I mean all the transactions like amalgamation, demerger, holding subsidiary. In all the cases where previous owner is taken, this Manjula Jesha case will be applicable. So friends, please understand that numerator, denominator of these things. That leads us to the discussion of what is this full value of consideration. Normally the sale consideration. Normally the sale consideration. In some cases it can be different. It can be insurance compensation. It can be compensation paid by the government. It can be fair market value on the date of transfer. Okay, it can be fair market value on the date of transfer. Okay. Okay, in the case of extinguishment, it can be insurance compensation. In the case of compulsory acquisition, it can be government compensation. In the case of conversion of asset into stock in trade, it can be FMV on the date of conversion, asset introduced by the partner, value recorded in book, distribution of partners on dissolution of firm or otherwise. Okay, yesterday we saw FMV on the date of distribution, that land question which was given to the partner who retired, we taxed it. Distribution on a liquidation of a company, it is taxable only to the member, monetary consideration plus fair market value of asset distributed minus deemed dividend under section 2 subsection 22 clause C. Transfer of immovable property 50C transaction, actual consideration or stamp value whichever is higher, where the stamp value does not exceed 105%, okay, of actual consideration, then actual consideration will be taken. Specified agreement, just now I told you, monetary consideration plus stamp value of area allotted. Unlisted shares, actual consideration or fair market value on the date of transfer, whichever is higher. Whichever is higher. These are all the cases where you can have a different, other than the sale consideration, you will take these things as the consideration for these many cases. Similarly, the cost of acquisition will have some aspects. Similarly, the cost of acquisition will have some aspect. Okay, don't look what is there in blue. This is because I was teaching for May 21 batch. Also, I took up the amendments. Okay, so asset acquired before 1/4/2001, actual cost or FMV as on 1/4/2001. Gift or inheritance or amalgamation, demerger, holding subsidiary, cost or book value of the previous owner, where the previous owner has acquired it on before 1/4/2001, then actual cost or FMV as on 1/4/2001, whichever is higher. Gift is already taxed under section 56. So, if a property is already at the time of gift itself taxed, amount already taxed under section 56 will become the cost of acquisition. So, a non-relative gifting, okay, I would have already paid the gift tax. Now that this principle of cost of acquisition of the previous owner will not come, amount already taxed under section 56 will hold good. Debentures converted into shares, cost of shares will be cost paid by debentures. Here the denominator changes. Asset acquired by partner on dissolution, rarest question. 50B is a very often asked question. Net worth of the on the date of slump sales. 50A depreciable asset. Sorry, it's 50 only. Question 50 depreciable asset. Opening WDV plus addition. Okay. Shares, we know what it is. Okay. Additional compensation. Okay, or route permit, bonus shares issued after 1/4/2001, everything nil. Okay, share of resultant company. This is in the time of demerger. This is in the time of demerger because I don't pay anything to get the shares of resultant company, but the cost of acquisition will be COA of demerging company into asset transferred by total asset of demerging company. Indexation benefit is not available for the following assets. Indexation benefit is not available for the following asset: STCA, depreciable asset, slum sales, debentures and bonds, listed shares, non-residents who are taxable at special rate. My dear friends, indexation benefit is not available for the following assets. Okay, STCA, depreciable asset, slum sales, debentures and bonds, 112A listed shares, and non-residents who are taxable at special rates. So if it is a simple question like how to compute capital gains, please don't get worried. They will give you the indexation value for 2, 3, 4 years, and then you have to be a little cautious which year it will come. Okay, I have given you the exceptions of numerator, I have given you the exceptions of denominator. Okay, very rarely it will be a straightforward question. If it is a straightforward question, it's a bonus. Okay, where we can do it. I also want you to understand this shares as a special case. Okay. I divide the shares into two: unlisted shares, listed shares. Listed shares, yesterday I told you the methodology of working. If it is purchased before 31/1/2018, if it is purchased after 31/1/2018, take it as it is. Purchased before 31/1/2018, okay. If the listed shares are purchased before 31/1/2018, there is a methodology of computation, okay, right? From the financial year 18/19, transfer of listed shares are taxable, then it will then till then it was exempt. Cost of compare FMV as on 31/1/2018 or full value of consideration, determine whichever is less. Okay, compare that answer of step 1 with the actual cost and determine whichever is higher. The answer of step 2 will be considered as cost of acquisition. Okay, yesterday we did a question. According to 112A, the computation will be exempt or not taxable till 1 lakh and taxable at 10% if the amount exceeding 1 lakh. Benefit of indexation not available. Rebate under 87A is not available. However, if there is a shortfall in the basic exemption limit, that can be adjusted. Where there are multiple trading rates on 31/1/2018, it has been clarified that the highest shall prevail for comparison. Where there is no trading on 31/1/88, okay, this is not question in the MCQ கேட்ட answer பண்ணுங்க. Unlisted shares, okay. Primary issue will be price paid for acquiring the shares, which will include premium as well, plus price paid for, if any, for acquiring the rights, renunciation of rights. When that for the transfer are fully taxable, for the transferee that will become the cost of acquisition. ESOP, FMV prevailing on the date of exercising option, bonus issue. Before 1/4/2001, I can take the fair market value as on 1/4/2001. On or after 1/4/2001, nil. So this is how, these are all the things which is required for you to understand. Okay, do not panic. These things will not be, you need not mug up these things. These things will fall in place once you start working. If such a question comes, you know, when you start your working, you will remember this is the provision. Okay, it will tap you. So do not worry, okay, that this is a lengthy one. No, no, it is not lengthy. It is very easy. Specified agreement may be something unique. Okay, otherwise everything, numerator or denominator changing will not give you any challenge. Okay, if you look at the whole format, this is what has been discussed. Okay, we now, okay, I just said full value of consideration, and the cases it can be different. Cost of transfer is simple. Okay, cost of acquisition and the cases in which it can differ. Indexed cost of acquisition, when numerator changes, denominator changes. Indexed cost of improvement, no such change. 54B EC F, individuals and HUF, though EC is available for all. D, G and GA is only for PGBP associates. 54 GB is a combo. It's for individuals, but it is sale of house property and investment in business. Okay, that's what, half an hour we can just put down the whole of the chapter into our mind in smaller spaces so that it will be capturing whatever is needed. Let us, as usual, start the day with some of the case laws and then go for amendments and then go for answering questions. Okay, let's go for some case law consolidation. First, let me tell you with regard to case law consolidation. Majority of the case laws are for exemption. Majority, not all, majority of the case laws. Okay, in my opinion, some one or two case laws gets a small importance, maybe a questionable area, one or two case laws. Okay, so otherwise, majority of the case laws are for exemption. Let us start with the famous Manjula Desha case, where the court has said the denominator can be the CIA of the previous owner. Okay, it can continue to be, the court has said it can continue to be the year of acquisition or 100. It need not be the year of gift or inheritance. Okay. Conversion of leasehold into freehold in this case is there both in assessment procedure as well as in capital gains. It has been highly settled that the charges paid for conversion of leasehold into freehold is cost of improvement and not cost of acquisition. Okay, acquisition is over as soon as I got it as lease. This what is paid is cost of improvement, is what, okay, is cost of improvement. Okay, Balakrishnan's case is something unique which is to be noted. Assessee entered into a settlement agreement with the government. The government compulsorily acquired. If a compulsory acquisition now, there will be original compensation. Where I am not satisfied with the original compensation, I will go to the court. The court can increase the compensation, which is known as additional compensation. But inga, this is a case where I settled in the court kalamana. Okay, I negotiated with the government for the compensation. AO said, since you have negotiated, I will not consider it as compulsory acquisition. But whereas the cost held by the Supreme Court, when it is acquired under the Land Acquisition Act of the government, it takes the character of compulsory acquisition. Mere negotiation will not change the character. Mere negotiation of sale consideration, full value of consideration, will not change the character. Okay, this is also there both in our assessment procedure and here Ravji by Nagji by Tisya. Okay, can I? Okay, right? Should the assessing officer wait for the valuation officer's report, or can he proceed? Where you have referred the case, to the valuation officer, then you have to wait for the valuation officer's report to complete assessment. More to do with assessment than to do with capital gains, but yeah, okay. So I told you, now onwards, majority of the case law are going to be only on exemption. Okay. So Ariyama Sundaram case, okay, we know that he's a very famous lawyer. He appeared in the recent cases also. Construction before sale of property, will it qualify for 54 exemption? You know, 54 exemption, what they are saying is purchase 1 year before or 2 years afterwards. Construction within 3 years from the date. So, construction, the law has not used before. But I have incurred some expenditure. I have started the construction, then only I sold the property. The question is whether the expenditure incurred before the transfer for construction, can it be claimed? The overall intention of the law is utilization. Okay, right? Section 54 does not make it mandatory to invest the same gain for the purpose of claiming exemption. So yes, even the prior to transfer can also be qualifying. Even prior to transfer can also be qualifying. Gurnam Singh, Ravindra Kumar Arora, Kamal Vahal, okay, all these cases are joint ownership. You can get joint ownership with son, joint ownership with spouse, registering the property only in the name of spouse, the new property. In all these cases, exemption will be granted. In all these cases, exemption will be granted. Investment criteria is fulfilled. Exemption will be granted. Okay. In the Syed Ali and Geeta Duhal case, if you remember, okay, two adjacent properties are purchased. Two adjacent properties are purchased. The in-between separation wall is removed, or there is an in-between door is constructed. Will it be treated as one property? Yes. Held by High Court, where there is a common meeting point, okay, or the separating wall is removed, then it will be treated as a single house property and the whole of the exemption can be claimed. Okay, Sambandham Uday Kumar's case gave Adu Seri, Hindustan Lever case Seri. Okay, in both these cases, within 6 months, the bond issue could not be completed, but I paid the consideration. Here also, within 3 years, I couldn't complete the construction, but I have proved my investment intention. The High Court has held favorably for the assessee. Even if you have not completed within 3 years, only some procedures can be pending. That is, okay, hence exemption cannot be denied. Hindustan Lever Leo, exemption was not denied. Bond was dated late, but I paid the consideration within 6 months. It is okay. Okay. BS Dempo is an important case to remember for all of us. BS Dempo is an important case. What is transferred? What is transferred is a short-term capital asset. What is transferred is a long-term capital asset providing short-term capital gain. One depreciable asset I sold. That depreciable asset is there with me for 5 years. The law gave a very good clarity there. It is a long-term capital asset giving us a short-term capital gain. Hence, 54 EC benefit can be claimed. Assessee sold a depreciable asset and invested in the proceedings in specified bonds held by Supreme Court. According to section 50, the resulting gain of sale of short-term depreciable asset is short-term. This does not mean that the asset is a short-term. The classification is different from computation. An LTCA can produce STCG. The law says asset transfer should be LTCA. The asset transfer was LTCA, so provide the exemption. Remember VS Dempo case, it's a very good case. It's a very good clarity that we got from that particular case. Gauli Mahadevappa already questioned in once or twice. If I don't have 50 seal prakaram, you are saying stamp value should be taken, which is more than the actual sale consideration. The law questions us, if it is more than the actual sale consideration, where is that extra money for me to invest? So I have to, from my other sources only, I have to invest. The court said, fine, you can. Okay, Hindustan Lever, I told you. Fiber board is like the previous case laws. Advance paid for shifting will also be taken. Okay, one of the two cases where I feel will be one of the three cases. VS Denko can be a standalone case. Shesha Steel Private Limited. Edanala in the case, எவ்வளோ வருஷம் கழிச்சு சுப்ரீம் கோர்ட்ல ஜட்ஜ்மெண்ட் 2004ல நடந்த ஒரு கேஸ்க்கு இந்த ஜட்ஜ்மெண்ட் இஸ் கமிங் நவ். ஓகே, any transaction which enables the enjoyment of immovable property can be considered as enjoyment as a purported owner, therefore, for being treated as transfer of capital asset and levy of capital gains. I will tell you the whole case law once. Give me a minute. Okay, I will like to spend some time to read the case so that you will understand it. Okay. Okay, I have taken this case also in our as a question, so now itself we will answer. Okay, have patience. The assessee did not file. Assessee is Shesha Steels Private Limited. Did not file a return for 2005. It was deducted. The assessee had sold a landed property at Perungudi, Chennai to a builder for a total consideration of 6 crore 10 lakhs dated 19th July 2003. Even then, neither any return of income was filed by the company nor any tax was paid on capital gain arising out of the sale. Notice reopened. Case was reopened, and since return is not passed, best judgment assessment. Finally, order under section 144 passed, taxing the entire sale consideration as capital gains. What is this transaction? Assessee entered into a transaction of agreement to sell with Vijayasanti Limited, Builders Limited, which provided that both parties were entitled for specific agreement. That is, I have a land and building, okay, 53A of Transfer of Properties Act. Under the agreement, the assessee gave permission to the builder to start construction on the land. Pursuant to this agreement, a power of attorney was given by the assessee to the director of the builder company, and and joint execution of sale agreement or sale deed in respect of the property after developing it into flats. So, அதுதான் 53A, transfer of possession of the land and building, okay, on partial performance of a contract. Okay, house property la deemed ownership concept and capital gains it is computed. Subsequently, a memorandum of compromise was entered into between the parties, under which agreement to sale and power of attorney was confirmed, and a sum of 50 lakhs was reduced from the total sale consideration. And the memorandum padikalam. Clause 3 of the compromise deed confirms that the assessee has received a sum of 4.68 crores out of the agreed sale consideration. Clause 4 recorded that the balance 1.05 crores towards full and final settlement in respect of the agreement entered into would be paid as post-dated check. Clause 5 stated that the last two checks would be presented upon due receipt of discharge certificate. The tribunal and the commissioner appeal concurred with the commissioner appeal na avaru on the judgment dhaan kuduthirukkaru. View that on or above the date of agreement of sale, the conditions mentioned in 247(5) could not be stated to have been complied with, and thus 53A of transferor could not be attracted. So, on the date when you paid the last check, it is completed. The tribunal held that the transfer took place in assessment year 4-5 as the last of the checks was received in January 2004. The assessee objected to the levy of capital gains in assessment year 2004-5 and ex parte assessment, that is assessment under 144 read with 147. The High Court ruled in favor of the department. Okay. Now the question went to Supreme Court. The issue under consideration is what constitute transfer for the purpose of act in relation to immovable property which is contracted to be sold. The Supreme Court, there is a precedence in the transfer under section 47 in one other case in 2018. Any transaction which has the effect of transferring or enabling enjoyment of any immovable property would come within its purview. The object of this section appearing is to bring within a tax net a de facto transfer of immovable property. Power of attorney transfer பண்றது மூலமா people were avoiding before. The law before was power of attorney was not taxable. When I was doing articles and power of attorney குடுத்துருவாங்க for the builder. The transaction was not at all under taxation net. But technically power of attorney it amounts to transfer. De facto transfer of immovable property. The expression enabling the enjoyment of takes color from the expression transferring, so that it is clear that any transaction which enables the enjoyment of immovable property must be enjoyment as a purported owner thereof. If I give them the power of attorney, it means I have given them all the rights over the property. The idea is to bring in within the tax net transactions where though title may not be transferred in law, but in substance it is transferred. The Supreme Court held in this case assessee's right in the said immovable property were extinguished on the date of receipt of the last check. And also the compromise deed could be stated to be a transaction which had the effect of transferring the immovable property. Accordingly, the transaction fell within the provisions of the Act. Hence, it is a transfer in relation to capital asset, and capital gains liability will be attracted. I think it will be a theory question. This is there in your judicial pronouncement. It is there in the judicial pronouncement. So please remember this. Okay. The date of receipt of last check In that date, all the enjoyment over the property is transferred, even though it is by an agreement to sell. It is by a power of attorney. Only you have done it. Okay. In that year, you are subjected to capital gains. Okay. This is one case. VS Dempo, Seshasai, okay, Malavika. This is also another case where I feel it is, though I have put it under IFOS, it is a very interesting case. Okay, it is a very interesting judgment. Okay, look at the case now. Value of property compulsorily acquired were originally determined, okay, by the local authority and was subsequently, okay, enhanced as the determination was wrong. Why it was enhanced? It is not because of a court order, it is enhanced because the valuation determined was wrong. Along with such enhanced value, interest was paid for wrong determination. Along with that enhanced value, interest was paid for wrong determination. Naanga tappa determine panto, so I am giving interest. The question in front of law, whether the interest portion is taxable under IFOS or capital gain. The interesting judgment held by the court that such interest is not for delayed payment of compensation, hence it is taxable under capital gain. Such interest is not for delayed payment of compensation. It is only for wrong determination of value. So that interest is like a capital interest. So it will be taxable under capital gain. Okay, I have put it under IFOS, but more relevant for capital gain. Okay, so remember BS Dempo, remember Seshasani, okay, and Malavika, okay. Any of these can be converted into a good theory question and asked. Otherwise, it can be a part of a practical question, all those exemption based provisions or the preliminary case laws, Balakrishnan, etc. Amendments which are applicable for your examination. The tolerance limit of 5%, please remember. The tolerance limit of 5%. 50 CA is not an amendment, it is an administrative amendment, okay, where the exceptions can be provided by the government if there is, in some cases, it is not, it is only an administrative government, okay. 54 is an amendment, questionable amendment. 54 is an amendment, okay. Okay, exemption extended for two house properties, okay, extension for two house property, where in the case of an individual or HUF, the LTCG from transfer of our property does not exceed 2 crores. Okay, the LTCG does not exceed 2 crores, then he will be getting the exemption for two properties. Okay, if it exceeds 2 crore, restricted to one property. Only in 54 this amendment, 54F does not have this amendment. 54F is still only one property. The benefit of two properties can be claimed only once in the lifetime of the assessee. Only once in the lifetime of the assessee. In the future years on the question varum. Okay, already I have claimed in it. So for your current year, you need not worry. Other provisions of the section, including time limits, remain the same. Okay, 54B, another point is, for that I told you, a sale of house property and the purchase of, investment in shares. Okay, it can be two types of companies: manufacturing company, technology related company. Okay, the scheme has been extended till 31st March 2021. இன்னும் extend பண்ணி தான் ஆகணும். இந்த வருஷம் யாரும் திருப்ப முடியாது. Shareholding is amended from 50% to 25%. Okay, previously you have to hold 51%. Now it is, if you hold 25% or more, you will get the eligible benefit and should not be transferred. Previously it was 5 years, within 3 years. Within 3 years. This is one other amendment, please remember. This is one other amendment. Amendment under 111A and 112A. We saw listed shares, equity. This is for payment of STT. Okay, this is for payment. Amendment is for STT. Okay, இதுல ஒரு important point இருக்கு, நான் நோட் பண்ண வைக்கிறேன். இது இங்க எழுதல, நோட்புக்ல எழுதிக்கணும். Apart from listed shares and equity oriented fund, share of business trust on which STT is paid is also included for this 15% and 10% tax. Okay, if for this 15% and 10% tax, Anna, friends, they amended this section. They did not amend the holding period section. Why I am taking this is, why I am talking this is, listed shares and equity oriented funds less than 12 months, STCA, otherwise LTCA. Anna, shares of business trust, even if STT is paid, less than 36 months only STCA, because a parallel amendment, we don't know whether it is failed to be made or omitted to be made. Let's leave that. Now, shares of business trust on which STT is paid, business trust we all know, securitization trust, REIT, investment fund. Okay, shares of business trust on which STT is paid is taxable at 15% if it is a short-term capital asset, 10% and up to 1 lakh exemption is available for them. Okay, but is the holding period amended? No. The holding period for shares of business trust continue to be, it is not coming under the listed shares category or equity oriented funds. It is not unlisted shares, so it goes to the third category, others. And the holding period is less than 36 months, more than 36 months. Less than 36 months, more than 36 months. So remember that part of it. It has not, the holding period has not changed. Okay, so amendment based question, இது இல்லை, இந்த amendment based question. Amendment based question can be on 54. Okay, and the 105% can somewhere figure out. Case law based questions or 3 case laws. Question number 1, Balakrishnan's case. Question number 1, in order to save time and mitigate the cost, assessee negotiated the sale agreement, sale consideration and got it enhanced. Assessee negotiated the sale consideration and got it enhanced. So it is Balakrishnan's case. Okay, AO failed to treat the said transaction as compulsory acquisition. Question number 2, I replicated the Seshasai because now I replicated the same case of Seshasai. Now I have given the elaborate answer. I read out the whole provision. Okay, we know that last check when it is presented, that is where transfer is completed. So don't worry. Okay, that is for Seshasai. Question number 3. The RTP of November 20. It is an old question. We have worked out in the classroom, but anyhow. RTP is full of study material. Mr. Hari a property dealer, sold a building in the course of his business to his friend Mr. Rajesh, who is a dealer in automobile spare parts for rupees 100 lakh on 1/1/2020 when the stamp value is 120 lakhs. The agreement was, however, entered on 1/9/2019 when the stamp duty value was 105 lakh. Mr. Hadi had received a down payment of 15 lakhs by NEFT from Mr. Rajesh on the date of agreement. Mr. Hari has purchased the building for 50 lakhs on 12/7/2018. Okay, this is one. Two, Mr. Ravi, a retail trader, sold a residential house to Mr. Valish, a wholesale trader, for 50 lakhs on 1/2/2020 when the stamp duty on that date was 70 lakh. The agreement was, however, entered into on 1/8/2019 when the stamp value was 55 lakh. Ravi received a down payment of 5 lakhs by crossed check from Mr. Valish on the date of agreement. Mr. Ravi had purchased the building for 32 lakhs. So, two questions actually in the okay. இது வந்து நம்ம RTP-ல objective question. Compute capital gain. Okay, it is an objective question. Compute capital gain ல ஒரு 5 objective. Okay, சோம்பேறி பசங்க. Okay, so let's do it separately. Let's do it as a question and do it. I have completed the trust question. Okay, I am waiting for you to complete and tell me the answers. Okay, I understand last night I completed late. Okay, the trust questions I have completed and posted. Manasa, I have a small difference in your answer. Okay, I will tell you what mistake after the class. Okay, stay back, I'll tell you what happened. Okay, now a 360-degree approach will help us to understand all the provisions in a better manner. Okay, let us start. Okay, Mr. Hari being a property dealer, Mr. Hari being a property dealer, my dear friends, Mr. Hari being a property dealer, section 43 CA is applicable. Okay, in the section மாத்திரம் நம்ம எப்பயுமே மறக்க மாட்டோம். Okay, sections wordings, sections alphabets or so section 43 CA is applicable. So Mr. Hari being a property dealer, section 43 CA is applicable. Okay, so what, not 50C. Mr. Hari sold the building in the course of his business to his friends, Mr. Dealer, okay, for 100 lakhs on 1/1/2020 when the stamp value was 120 lakh. The agreement was entered into on 1/9/2019, 15 lakhs by way of NEFT. 15 lakhs by way of NEFT from Mr. Rajesh. In the NEFT recently included other prescribed modes. Other prescribed modes, they have included all this credit card, debit card, NEFT, RTGS, okay, BMAP, UPI, okay, okay, UPR codes, okay, all these things they have included from Mr. Rajesh on the date of agreement. So, in the law, three sections I am consolidating. Section 43CA, Section 50C, Section 56 gift provision. All these three things can be read together. All these three things can be read together. If you don't mind, I will take that also. I have written in the class for you, but anyhow. Mm, okay. This is the provision. I'll again come back to this. Okay. Where I have written. Okay. Date of determination of stamp value. For all the three sections, this is the provision. Date of determination of stamp value, where advance is paid, for easy understanding I'm saying, for advance, where advance is paid by cash, bearer check, cross the check. For easy understanding I'm saying, where advance is paid by cash, bearer check, cross check, date of registration will only be considered. Where advance is paid by account payee check, account payee draft, and all the prescribed channels, then date of agreement will be considered. Then date of agreement will be considered. Friends, repeating the point, okay, in the moon section, okay, there we are speaking, in IFOS, we are speaking about inadequate consideration, difference between stamp value and the consideration fee. Cancel stamp value on what date? Okay, is the question. Two, in 50C capital gains, we are saying immovable property transfer, okay, actual consideration or stamp value. Stamp value on what date? Third, 43CA. If it is a stock in trade, 50C is not applicable. 43CA is only applicable. Stamp value on what date? In all the three sections, okay, we are looking at what is the date of stamp value for which the law has answered. I don't know whether I wrote it here. Sorry, I have written it here. Okay, 50C, 43CA, and 56 gift provision. 50C, whether land and building is transferred, the same needs to be registered with the stamp authority. According to this section, full value of consideration will be actual consideration or stamp value, whichever is higher. Stamp value not exceeding 105, actual consideration. Okay, assessee has the option to contest the stamp value, etc. 43CA has the same provisions. 56 is also having the same provision. In all the three cases, this is the same. But in all the three cases, what is the date of stamp value? That's what here comes. What is determination of stamp value on which date is a question. It depends upon whether you paid advance or not. If you have paid advance, on what mode you have paid the advance? If you have paid the advance by cash, bearer check, cross the check, or you have not paid the advance. Four cases: not paid advance, cash, bearer check, cross the check. Then date of registration. I will take it. இப்பதான் transaction. Now only the transaction is taking place. But if you have paid the advance by account pay check, account pay draft, draft, and any of the banking prescribed channels, then I accept. Then the date of agreement, booking will only be considered. Keeping all these things, I am reading this question. Mr. Hari, a property dealer, sold a building in the course of his business to his friend Mr. Rajesh, who is a dealer, 100 lakhs, when the stamp duty on the date of registration was 120 lakhs. The agreement was, however, entered in 1/9/2019 when the stamp duty was 105 lakh and he has received by banking channels, no problem. So, okay, advance was received through prescribed mode. Okay, stamp value prevailing on the date of agreement will be considered. Stamp value prevailing on the date of agreement will be considered. Okay, stamp value prevailing on the date of agreement will only be considered because it is in prescribed mode. Now I'm going for the computation. Actual consideration okay, when the stamp, okay, 100 lakhs. Okay, I do it in lakhs itself. Computation of business profit, because okay, he is coming under business profession. Okay, in lakhs. Okay, I'm working it on lakhs. Okay, actual consideration 100 lakhs. Stamp value on the date of agreement, because he has paid the consideration in it 105 lakhs. 105 lakhs. Okay, 105% of actual consideration. Okay, 105 percentage of actual consideration. Okay, one on. Since the stamp value has not exceeded, remember it should exceed, okay, not exceeded 105% of actual consideration. Actual consideration will be taken for computation. So it will be 100. So it will be 100. Since the stamp value has not exceeded 105%, I will take 100. Okay. Mr. Hari has purchased it for 50 lakhs on 12/7/18. Less purchase price, business profit, business profit 50 lakhs. Okay, ஏன்னா examination tensionல அவசரத்துல ஏதாவது indexation போட்டுறாதீங்க. He is a property dealer, so for him it will not come. Okay, this is for Hari, and the recipient here in this case is Mr. Rajesh. Okay, for Mr. Rajesh, for Mr. Rajesh, 56 will not apply, gift provision will not apply, ஆனா எழுதிடலாம். Okay, the difference between consideration paid and stamp value prevailing on the date of agreement will be treated as inadequate consideration, and if such inadequate consideration, first I am writing the provision, and if such inadequate consideration exceeds rupees 50,000, then the whole amount, whole inadequate consideration becomes taxable. However, if the difference is not exceeding 5%, then okay, inadequate consideration is not taxable. So in this case, it is not exceeding. Okay, in this case, it is not exceeding, so not taxable. In this case, okay, in the given case, the difference does not exceed 5%, hence not taxable. So for Rajesh also, 56 will not have a problem. For Hari also, there will not be a problem. Question number 3, part B.
Sir, can you please scroll up for a minute?
Okay, friend.
Yes, sir. Yes, sir.
Question number 3, part B. Let us answer the part B. Now capital gains gets the shape. Mr. Ravi, a retail trader, sold a residential house, okay, to Mr. Valesh for a consideration of 50 lakhs, okay, for a consideration of 50 lakhs on 1/1/2020 when the stamp value was 70 lakhs. The agreement was entered and Ravi made the down payment of 5 lakhs by crossed check. By crossed check, not acceptable, says the law now. Okay, the Supreme Court judgment is applicable here also. Okay, computation of capital gains for Mr. Ravi. Okay, actual consideration actual consideration 50 lakhs. Okay, absolute value la payla. Okay, actual consideration 50 lakhs. Stamp value on the date of registration as the stamp value on the date of registration as the advance was received otherwise than by, use the word otherwise than by, as the advance was received by cross the check because the correct wording is otherwise than by account payee check or draft or prescribed modes. So stamp value on the date of registration will only be considered, okay, when the stamp value was 70 lakhs. 70 lakhs. 105% of actual consideration. Always examination, let's check this condition also. Okay, is okay. Since stamp value exceeds 105% of actual consideration, okay, stamp value becomes a full value of consideration. So this will be 70 lakhs. Full value of consideration will be 70 lakhs less, okay, ICOA, less ICOA. Okay, Mr. Ravi has purchased this property on 17/8/2018. He is so selling it for 1/2. Sorry, it's not ICOA. Okay, right? He is selling it on 1/2. It is only COA because the 2 years have not yet completed. The 2 years are not yet completed. So, okay, it is not ICOA. Okay, it is only COA because, okay, 2 years. Uh, okay, so, okay, other institute, let institute, like usually within bracket, they will give you the indexation. Okay, 32 lakhs. Okay, now comes short term capital gain. Now comes short term capital gain. Okay, this is for Mr. Ravi short term capital gain. This is for Mr. Ravi short term capital gain. Computation for Mr. Manish. Okay, right. Stamp value on the date of registration. Okay, stamp value on the date of registration 70 lakhs. Stamp value on the date of registration 70 lakhs less actual consideration, okay, which is 50 lakhs, which is 50 lakhs. Okay, inadequate consideration, inadequate consideration is 20 lakhs. Okay, since the inadequate consideration exceeds rupees 50,000, whole of such inadequate consideration becomes taxable. Okay, friends. Question number 4. Krishna inherited his grandfather's land in May 2012. His grandfather had purchased it in the year 89 for rupees 12 lakhs. The FMV on the date of on 1st April 2001 40 lakhs. Krishna sold this land during the year for 2.75 crores, stamp value being 3 crores. Compute the capital gain under the following circumstances. Using the proceeds, Krishna invested in 2 apartments, each costing 80 lakhs. That is case A. Case B. If it is 2 adjacent flats and the in-between partition removed, will your answer change? Case C. If the property is registered in the joint names or in the name of spouse alone, will your answer change? Okay. Case 2 and case 3 is just that our answer will not change because of such and such case law. Okay, or there will be a small change, but let's work out. And after this question, so that you are understanding together some case law and also the 54 exemption. Okay, we are supposed to do two answers as per law, as per Manjula J. Shah. Okay, we are supposed to do two different answers. Okay, full value of consideration. Okay, full value of consideration. We need to work out. Okay, all right. Actual sale value. Okay, in both the cases it will be the same, so I'll work out. Actual sale value is 2 crores 75 lakhs. Stamp value is 3 crores. 105% of actual consideration. Okay, since stamp value exceeds 105%, okay, stamp value will become full value of consideration. So in both the cases, it will be 3 crores. Less ICOA, less indexed cost of acquisition. As per law, first I am going. Okay, it is inherited in May 2012, and the FMV was 40. I mean, on 2001 is 40 lakhs into 289. Can somebody tell me 12, 13 values? May 2012.
200, sir.
200. So it will be okay 40 lakhs into 289 divided by 200. Okay. On the other hand, it will be 40 lakhs into 289 by 100 because whatever is the previous owner's benefit, I can get it. So 40 lakhs into 289 by 100. I wanted to give one case it exceeds 2 crores, another case it is less than 2 crores. So that together I can give you the provisions. So 2 crore 42 lakh 20,000. Exemption under section 54. Exemption under section 54. As per law computation, the gross gain exceeds rupees 2 crores. So exemption can be claimed only for one property. As per law computation, gross gain exceeds 2 crores. So exemption can be claimed only for one property using the invested in two apartments, each costing 80 lakhs. So I can only claim for 180 lakhs. Okay. As per Manjula Jesha computation, okay, gross gain is less than rupees 2 crores. Hence, exemption can be claimed for two properties. Okay. Example, however, it is one time so that we are clear. Okay. So here I can claim for two properties. Okay. 1 crore 60 lakhs. Okay. 1 crore 6220 and 2440. That is the difference. That is the difference. Okay. Part B. If it is two adjacent flats and in between partition is removed, okay, it will be considered for the Syed Ali case, okay. In Syed Ali case, it is held where in between partition wall is removed or there is a common meeting point, as in the Gita Digul case, okay, where there is a common meeting point, then it will be treated as one house property. Okay, it will not be treated as, even though there may be two sale deeds, it will be treated as one house property. Okay, in this case, the law answer will only be changing. Okay, gross LPCG will, okay, the answer will be the same for both. Okay, less exemption under section 54, the entire amount can be claimed as it is treated as one property, even though there are two sale deeds. Even though there are two sale deeds. So 1 crore 60 lakhs can be claimed. 1 crore 60 lakhs can be claimed. Taxable LTCG, okay, taxable LTCG will be 82 lakh 20,000. Here the other case the answer will not change. Okay, 82 lakh 20,000 will be the taxable LTCG because it will be treated as one property. Okay, if two adjacent flats and in between, okay, if the property is registered in the name of joint name Gurnam Singh, okay, Ravindra Kumar Arora, or in the name of spouse Kamal Wahar, will your answer change? No. The first one is Gurnam Singh, Ravindra Kumar Arora, and the last one only in the name of spouse Kamal Wahar. Question number 4. PQR Manufacturing Limited, a manufacturing company, was transporting its machines from one unit to another unit at a distance of 275 kilometers on 29th November by a truck. On account of civil disturbances, the machinery was destroyed. The insurance company paid 22 lakhs for the destroyed machines. On these facts, for submitting the return of income for the previous year ending 31st 2020, your advice is sought to as to A. Does the destruction of machine result in any transfer? B. How would the amount received from the insurance company be treated for taxability? C. Will the company be able to save tax by investing in 54 EC bonds if the compensation results in capital gains? Yes, it results in capital gain. Transfer includes extinguishment of asset as well. Okay, transfer includes extinguishment of asset as well. So the compensation paid, okay, so destroyal will amount to transfer. Okay, the compensation paid by the insurance company will be treated as full value of consideration and reduced from the block value. Okay, reduced from the block value. Yes, it is capital gains and it will be treated so. How would the amount received from the insurance company be treated for tax liability? Part 2. Okay, the amount received will be reduced from block value if on reduction the block cease to exist. Okay, if on reduction there is a positive, that is the block cease to exist, then STCG will be computed liable to STCG will be computed if by reducing it from the block value, if it has resulted in short-term capital gain, STCG will be computed. Part 3. Would the company be liable to save tax by investing in 54 EC? BS Dempo. Okay. If the asset transferred, in this case, Destroil is also transferred, okay, is held for a period of 36 months or more, then it will be a long-term capital asset resulting in STCG. Assessee can claim the benefit exemption by investing in 54 EC bonds. Question number 5. Mr. X was the owner of a residential house comprising of 2 floors. In April 2019, he entered into a collaboration agreement with Arihan Builders for developing the property. According to the terms of agreement, Arihan Builders were to demolish the existing structure on the plot of land and develop, construct and put up building consisting of 4 independent floors. Mr. X is to be allotted 1 floor and 25% of undivided land area. The cost of construction of each floor was 1 crore, which was borne by the builder. The stamp value of the whole land amounted to 5 crores, and in addition, X was paid 40 lakhs as monetary consideration. You are required to discuss and resolve the following issues arising in the assessment of Mr. X as a result of above transaction. A. For computation of capital gain, what will be the full value of consideration accruing as a result of transfer? B. If Mr. X has acquired the said property in 2002-3 for rupees 74 lakhs, what will be the quantum of capital gain? C. What are all the various ways by which X can plan reducing the capital gains? Specified agreement. This comes under, my dear friends, specified agreement. Okay. Full value of consideration. How I am determining? Stamp value of undivided land area. Stamp value of, my dear friends, undivided land area. So the stamp value of whole of the land amounted to 5 crores. He was given 25% of the undivided land area. Okay, so 5 crores into 25%, 1 crore 25 lakhs. FMV of the apartment allotted, in this case I will take the construction cost. They have not given the FMV, so we will take the construction cost. Okay, Mr. X is allotted 1 floor. Okay, he is allotted 1 floor and the cost of construction was 1 crore. For per floor, the cost of construction is 1 crore. Monetary consideration is 40 lakhs. Monetary consideration is 40 lakhs. Okay, so our full value of consideration will be the total of these three things. Our full value of consideration will be 2 crore 65 lakhs. Less indexed cost of acquisition. Less indexed cost of acquisition, my dear friends. Okay, okay, he entered into a collaboration agreement, etc. He purchased the property for 74 lakhs into 3. Okay, 74 lakhs into 289 divided by 1 2 na 108,
109, sir.
109. Okay,
Sir, 2 3 is 105, sir.
105. Okay, okay, 61 32 381. Okay, how we can avoid is, okay, investing in 54 EC bonds within 6 months. Okay, capital gain to the extent of rupees 50 lakhs can be avoided. Ms. Soumya purchased a residential house in April 2004 for 30 lakhs. She sold the house on 7th November 2019 for 120 lakhs when the stamp value was 150 lakhs. She paid brokerage of 1% on sale price. She invested 100 lakhs in January 2020 in equity shares of Silicon Chips Private Limited, a newly formed technology company which qualifies to be a small enterprise. Ms. Soumya holds 29% of the share capital. I purposefully made it as 29 because now it is 25% itself, 54 GB applicable. 25% itself, 54 GB is applicable. The company utilized the sum of rupees 100 lakhs in the following manner: purchase of electronic, electrical and technology related assets 85 lakhs, including 8 lakhs for air conditioner, which will not qualify. Okay, which will not qualify. Deposit in specified bank without due date of filing returns 15 lakhs. The due date of filing returns is 30th September. Assume that she files on 28th September. Compute the taxable capital gain arising from the above transaction for AY 2021. April 2004. So 45, please. Oh, there is a, sorry, small. So 1 minute, 1 minute.
113, sir.
Yeah, okay, 1 minute. Less cost of transfer is always 1% of sale value. One one three. That's what our friend says. 113. Okay, how does this particular exemption work out? How does this particular exemption work out? It is not what the assessee has invested in the company. It is in turn what the company has invested in applicable assets. If it is manufacturing, then the applicable assets are plant and machinery, etc. If it is technology related company, then computers, electrical, but everything should be field or everything should be income producing asset, not this air conditioner and all, but deposit will qualify. So out of 85 lakhs, 8 lakhs will not qualify, but this 15 lakhs will qualify. Okay, 15 lakhs will qualify. So exemption is, okay, I'll write the formula, gross LTCG into amount invested in eligible assets, okay, plus deposits divided by net consideration, similar to our 54F exemption, similar to our 54F exemption. Okay, 72 lakh 7,434 into, okay, I will get 85 plus 15, 1 crore minus 8 lakhs. Repeating, 85 plus 15. The deposit will qualify 1 crore. This air conditioner will not qualify. So into 92 lakhs divided by net consideration.
Sir, is there, sir?
Yeah, listening.
Yeah, is there a specific time limit for depositing or
Before
because,
due date of filing returns, and the deposited sum should be utilized within 1 year.
okay. So the actual date of deposit, actual date of filing return is not the criteria.
No.
Okay.
Okay. And please understand, okay, according to the amended law, holding 25% or more in a technology related startup qualifies under 54G. Yeah, I got your point. I should have mentioned here 15th September. I got your point. You are asking You filed and then later deposited. I should have swapped the dates. Question number 8 is for you to work. The most simplest question. There are 2 8s. The other 8 you have to work. Okay. The most simplest question you can definitely try. It is slump sales. Slump sales is somehow the favorite area of questioners. Okay. Slump sales can be a standalone question. If slump sales comes, miss not that particular question. X limited. I'm going to the next question. Should have been 9, but number is this is 8. So let's call it 8A. X limited, a company in which whole of its share capital was held by Y limited. Both X Limited and Y Limited were Indian companies. X Limited had made investment in shares of ABC Limited in 1989 for rupees 3 lakh, which it sold to Y Limited on 1st April 2009 for a consideration of 30 lakhs. The fair market value of these shares of ABC Limited as on 1/4/2001 20 lakhs. Y Limited disinvested 5% of shares in X Limited in January 2020 by sale to public. It sold the shares in ABC Limited in March 2020, acquired by it from Y Limited for a X Limited for a sum of 70 lakhs. Discuss the issue with relevant to provision and tax effect of the transaction in the hands of both X Limited and Y Limited in the relevant assessment years. My mistake, Manasa, I should have given it as land and building. My intention was land and building only. My intention was to give it as land and building. So please take it as land and building. Our friend says that in Krishna's question, okay, his father had inherited land in Kuturne. Okay, I should have given it as land because if it's land 54F is only applicable. But my intention of this question is to make you understand 54 only, not 54F. So kindly change it to land and building. Kindly change it to land and building. If it is land, the computation differs. Both Manjula Jesha and as per law, only one house property can be claimed and you should not be owner of any other house property like that condition. But my intention was not to give it as 54F. My intention was 54. So kindly make it as land and building, friends. Question number 8A. Okay. For X limited. For X limited, my dear friends, for X limited, how does this work? For X limited, how does this work? Okay, transfer of asset by a holding company to its subsidiary, to its 100% subsidiary company or vice versa will not be regarded as transfer. Hence, no capital gain arises. For X Limited, the question says X Limited is a company in which the whole share capital was held by her, okay, or vice versa, will not be regarded as transfer. I'll add one more point. Provided the transferee company is an Indian company. Okay, transfer of asset by a holding company to its 100% subsidiary company or vice versa will not be regarded as transfer provided the transferee company is an Indian company. Hence, in this case, okay, both are Indian companies, so there is no capital gain. There is no capital gain. Subsequent, okay, subsequent sale of shares will not change the character of transfer. Okay, subsequent, I can even say subsequent disinvestment. Okay, when I say sale of shares here, I mean disinvestment in subsidiary. Subsequent disinvestment in subsidiary will not change the character. On that date, it is not a transfer, no capital gain arises. So for X Limited, there is not going to be any capital gains. For Y Limited, my dear friends, for Y Limited, okay, how does this provision work? Okay, Y Limited is okay. It sold the shares of ABC Limited in March 2020, acquired from X Limited for rupees 70 lakhs. They have not said that it is sold through stock exchange, etc. So we consider it as an unlisted company and start working. Remember, it has been acquired, okay, on April 1st, 2009. Okay, so there will be two. Where I am going to take the cost of the previous owner. I am going to take the cost of the previous owner. Whenever I take the cost of the previous owner, I need to work out the answer in two ways, as per law and as per Manjula J. Shah. As per law and as per Manjula J. Shah. Okay. Full value of consideration 70 lakhs. I hope there is no cost of transfer, so this becomes the net consideration also. Less indexed cost of acquisition. Less indexed cost of acquisition. So this was acquired by the previous company in 1989. So the fair market value is 20 lakhs. Okay, the fair market value is 20 lakhs. According to law, 20 lakhs into 289 divided by it was inherited, okay, or it was sold, okay, on 1st April 2009. 1st April 2009. Can I get the indexation of 910? 1st April 2009.
148, sir. 910.
148, Raja.
Yes, sir.
Okay, whereas if it is Manjula Desha case, it will be into 289 by 100. It will be 289 by 100. Okay, right? That is the difference.
Sir,
Raja?
நீங்க 289 by 290 by 148 போட்டீங்கன்னு நினைக்கிறேன் சார் ஃபார்முலா ஃபார் தி as per law case.
So this will be the gross gain in the case of holding subsidiary. Okay, it's when the subsidiary subsequently sells. Idhula, one of the question in our examination twisted a small thing. I sold it to a foreign subsidiary. Okay, I sold it to my foreign subsidiary. In that case, capital gains would have been computed for X Limited itself. Here, both are Indian companies, so capital gain does not arise. Suppose if it has sold to a foreign subsidiary, obviously capital gains will arise and the amount will become taxable. Obviously, for capital gains will arise, okay, and for the holding company itself, the amount will become taxable. Question number 9. VM Limited, which owns an industrial undertaking in Delhi, decided to shift itself to a backward area in Haryana. Following assets are held by the company: plant and machinery, building, industrial land which was acquired in 91 and the FMV is 3 lakh. In order to establish, the assets were sold as follows: plant and machinery, land and building, land. The new assets acquired in Noida are, okay, should be Haryana's part. Okay, plant and machinery 15 lakhs, 3 lakhs subsidy received from government. So it should only be regarded as 12 lakh investment. It should be only regarded as 12 lakh investment. Land and building for which advance has been given 20 lakhs, additional 5 lakhs needs to be paid. Compute capital gain. Okay, I'm leaving that question to you. You want me to work out? I'm leaving that question to you. 54G. Okay, it has been worked out in the class. You can check it out. Okay, you can, but do work it out. Question number 10. Ashish Mehta owns acres of land which was purchased in 83-84 for 6,10,000. Okay, Ashish converts this property as stock in trade in the business in 1617, recording a value of 50 lakhs when the fair market value was 65 lakhs. Ashish spends 31 lakhs for construction and 2,45,000 for approval. This is after conversion, so it becomes business expenditure. This is not cost of improvement, this becomes business expenditure. Okay, he starts to develop the property in March 17. In April 19, he enters into an agreement to sell 2 houses for 40 lakhs each, receives advance of 10 lakhs for house 1 in cash and for house 2 through check. Stamp value on that date was 35 lakh. In February 20, he completes the said properties into 4 houses and sells them, all of them. The remaining 2 houses were sold for 51 lakhs. Stamp value on that date is 45 lakh. Out of the sale consideration received, he invested 50 lakhs in NHAI on 31st March 2020 and 50 lakhs in REC bonds in April 2020. Determine the year of taxability of conversion and the sale and the amount chargeable to tax under CG and PGBP. Also rework the solution. If the land was initially purchased as stock in trade, subsequently converted into capital asset, all other factors remaining the same. Read through. So I forgot to give you the 2001 value. Let us work it out with taking 610 itself. Okay. While typing, I forgot to give you the 2001 value. Let us take it as 6,10,000 itself and start working. Okay. Sorry, it is not 289. It is not 289. It should be year of conversion. It should be year of conversion. Okay. The year of conversion is 2016-17. Can you give me the
264, sir.
264? In April, he enters into an agreement and sells 40 lakhs each and receives 10 lakhs in cash for house 1 and house 2, 2 lakhs in check. Forty lakhs per house. Okay, I'll take it for per house. And it was sold for 51 each house. Campbell and the debt for 45 lakhs. For the second part of the question, I will write the theoretical answer. That's more than sufficient. Conversion of stock into asset. Conversion of stock into asset. FMV on the date of conversion will be taken as sale value and business profit will be computed. So as a first step, FMV on the date of conversion will be taken as sale value and then you will compute the business profit. FMV will be taken as actual cost of asset. The FMV which you are considering as sale value will be taken as actual cost of the asset. Depreciation will be provided when the asset is subsequently sold. Depreciation will be provided it's a depreciable asset. Subsequently sold, capital gain, either short term or long term, will arise. Okay. So this is a 2018 provision, where if the stock in trade is converted into asset, take the fair market value and compute the business profit first. As if you have sold the asset to an external party, compute the business profit, record it. I'll give you a benefit. Take that fair market value as the actual cost of the asset. Continue to provide depreciation if it is an asset other than land. If it is land, maintain it. When the asset is subsequently sold, compute the STCG or LTCG arising from it. Give me a 5-minute break, please. For the couple of questions which are being asked, the 54 GB, not 54B, it is 54 GB. I typed it as 54B, it should be 54 GB.
Sir,
Yeah.
in that amendment, that 3 years is only for computers and computer software and
technology
for
related.
all other assets.
Technology related companies, startups. Our friend's question
And
was.
sir,
Once more, friend.
and in question number 5, when you have set the various ways to reduce the capital gains tax, only 54 EC you have told. Why no 54?
Actually, yes, 54 is also applicable. 54 is internally applicable there. That case is still pending with the court because what I transferred is also land and building. What I got back is also land and building. Rama Rani Kalyan, or case is still pending. Can I claim 54 in that? Because what I agree with you, 54 is also applicable. As of now, for the examination purposes, restricted to 54 EC.
Sir,
Go ahead.
and the 54 GB, the new asset, it is for both plant and technology related. Whatever we buy for the startup entity, the whole thing.
This amendment, they are restricting, they are more talking about technology related, but there is a place where they said 54 GB is applicable. This 3 years is restricted to technology related assets.
So plant and machinery, there's no
Will
restriction as
continue
of
to
now.
be 5 years. They will make the consequential amendment this year.
Oh, okay, sir. Thank you.
Okay, and yeah, one other case law which you were asking explanation, Manasa, is Aditya Kumar Jajodia. Okay, should it form? I have written it is forming part of cost of improvement. The cost of acquisition cost of improvement. I will give you one explanation. Okay, both are right. Okay, there is another parallel case law which is going in assessment and procedures. If it is in the current year, if I have transferred and conversion of leasehold and the charges paid is in the current year, the law says take it as cost of improvement. If it is past years, why the law says take it as cost of acquisition is you can index it also. If it has been one of the past years, but I feel even cost of improvement can be indexed. Whether you take it as cost of acquisition or cost of indexation does not make any difference. Okay, because in this question, in this particular case law, the assessee claimed the indexation benefit also for the charges paid, which is applicable. Even if you have taken it as cost of acquisition, the indexation is going to be the same. Even if you take it as cost of improvement, the indexation is the same. There is a case law in assessment procedure also where they say it is cost of improvement. So whether you take it as cost of acquisition or cost of improvement, it is not going to make any difference. You can take it as so.
Okay, sir.
54, yeah, that one, Aditya Kumar and the other thing. Okay, so this is with regard to capital gains. Standalone questions can be, I am repeating, standalone questions can be even in the May 2020, a similar question of whatever I gave you as homework as for slum sales is there. Okay, so standalone question can be slum sales. It can be section 54 in my opinion because of the amendment of 2 houses. Okay, that can also come, or it will be clubbed along with assessment of individual somethings, etc. Standalone questions of case laws can be the 4 case laws which I told you. Apart from it, 112A can be a questionable area. How to identify the cost of asset and up to 1 lakh exempt and the balance taxable. Apart from it, it will be a very simple, straightforward question. If at all there is going to be any other question, it is going to be very simple or straightforward question. Okay, with the hands tied up to 70 marks only. With hands tied up to 70 marks only, standalone question in capital gains will become slightly rare, but I'm not ruling out. Because of 54, now I'm not ruling out because of the amendment. Next year also there are a couple of amendments. So there might be a standalone question, whatever be it standalone, be it part of the adjustment, be it a case law question. I am very confident if you go through these things, whatever we have worked out in the classroom, plus in assessment of individual, I will work out some more capital gains on the basis of individuals. Okay, so when we are doing all those things, we should feel very confident that we will be able to make it. Okay, do not worry, we will be definitely able to make it. Okay, the next 1.5 hours we will discuss business trust, pass-through entities, and then reserve the assessment of companies for the evening, so that way we are not halfway through in our discussion. Okay, and business, the question is also here little predictable in the case of pass-through entities. So let's go to the pass-through entities now. Okay, by pass-through entities, what do I mean? By pass-through entities, I mean that there are 3 parties involved. Okay, unit holder, entity where they park their funds or invest their funds, which is known as a middleman or middle enterprise. They in turn invest it in various companies, various properties, various debt, etc. Get the return, give it back to the unit holders. So you are all unit holders. You invest in me. I park it in some. I invest in turn invest in lot of funds. Whatever return I get, almost 90% retaining a small portion, I am giving it to you. So I am a pass-through entity. I am a pass, instead of you directly investing, be it small holders, etc., various reasons, you are not investing directly. You want somebody to manage, etc., you are not investing directly. So here I am just a pass-through entity. I collect money from you, give it to the investors. Investors in turn return the money, I give it back to you. So I act as just a pass-through entity. There are three types of pass-through entities. I'm not talking about mutual funds now, that even though that will, but mutual funds is taxed than the dividend distribution tax. The rates of taxes are different. All the more, mutual fund is not going to be a question because DTT goes away. 115 over rare, model 115 are very, very rare of questioning. Okay, so our focus can be in business trust, investment fund, and securitization fund. All the three are going to be pass-through entities. I'm taking to this opportunity to adjust one small one error which I made in the classroom. I will tell you what it is. Okay, so we will talk about all these three types of entities. That is, first let me talk about business trust. First, let me talk about business trust. Okay, little elaborately, but quickly we can summarize the provision. Okay. Okay. First, I am going to talk about business trust. What is this business trust? Okay, there are two types of organization which are spoken about: real estate investment trust, and then InvIT. Okay, investment trust. Okay, if you want to know the idea, real estate investment trust invest in commercial properties and residential properties. Investment trust invest in infrastructure, roads, airports, ports, etc. Okay, this is the difference between, but majority of the things inga rental income kadayadu, michapadi the provisions are going to be the same. Okay, real estate investment trust and investment trust. Okay, so there are three parties: unit holders, okay, REIT. For example, I am taking REIT. Wherever I am putting REIT, you can put InvIT also. Okay. Investing in SPV or other assets. Okay. SPV stands for special purpose vehicle. How do I call something as a special purpose vehicle? I call something as a special purpose vehicle where if I am the major stakeholder there. Where I am the major stakeholder there, I call it as a special purpose vehicle. Okay, so unit holder REIT, and so unit holder invest in REIT, REIT invest in SPVs or any other assets. How does this taxation system works? Okay, the investment made by REIT, okay, in SPV, okay, it can result in interest. If the investment is in, it is interest, it will enjoy a pass-through status. it will enjoy a pass-through status. It will enjoy a pass-through status. Dividend. Okay. Dividend. Okay. This is the small thing. This is the correction I want to make. Okay. Dividend. Okay. SPVs are classified into two. SPVs are classified into two. Dividend from 100% SPV. Dividend from 100% SPV, not taxable for REIT, not taxable for REIT, not taxable for unit holders, DTT not applicable. Okay. Dividend from a 100% special purpose vehicle, entire shares are held by REIT. The dividend is not taxable for REIT, not taxable for unit holder, 1023 exemptions are available, and DTT not applicable. Okay. The dividend distribution tax 115O not applicable. Okay. Dividend from SPV where 100% holding is not there. Okay. Dividend from an SPV where 100% holding is not there. Okay. This is the, I did this provision and stopped in the classroom. Okay. SPV means dividend not taxable for REIT, not taxable for unit holder, not DTT not applicable. But in my later study and preparation, when I read the act, I was noticing this wholly owned. At that time, I realized that I should have differentiated the dividend. That's why I'm wanting to differentiate here. Dividend from SPV, where 100% holding is not going to be there. Here, taxable for REIT, provisions of 1034 and 115 BBDA applicable. If the dividend is not, okay, please understand. If the dividend is from SPV, if 100% SPV, pass through status. Ellarkum not taxable at all levels. If the dividend is from a not wholly owned SPV, it is still an SPV. I own more than 51%. But that dividend is taxable in the hands of REIT only. That dividend is taxable in the hands of REIT only. Okay. Up to 10 lakhs not taxable. More than 10 lakhs, it is taxable at 10%. Okay. SPV will pay DTT exempt for unit holders. So this is the thing I did not do in the classroom. If the dividend is from a 100% SPV, all levels not taxable. Not even for the unit holders. Unit holders ku 115 BBDA applicable illa. Ena this dividend is exempt under 1023F. FCA. Okay, this dividend is not exempt under 1034. 1034 exempt nada, it is up to restricted up to 10 lakhs. This dividend is not under 1034, it is coming under 1023 itself. So whole dividend is exempt for the unit holder, for you all exempt, for me exempt, for the SPV, DTT is not taxable. If it is wholly owned SPV. If it is not a wholly owned SPV, if it is not a wholly owned SPV, then the provision is taxable, okay? Where it is not a wholly owned SPV, then the provision is, it becomes tax again for you all, unit holders, it is exempt. Okay? But SPV has to pay DTT and business trust it is taxable. Okay, provisions of 1023, 34 and 115 BBD will be applicable. Okay, this is the correction which I want to make from our classroom. Okay, right? So in SPV, I can get interest which will enjoy pass through. I will write a detailed answer on TDS provision there, and dividend which depends upon whether it is an 100% SPV or now wholly owned or not wholly owned. If it is wholly owned, exempt at all ends. Not wholly owned, REIT will become taxable, not the unit holders, and SPV is liable to pay DTT. Sale of shares. Sale of shares. If the shares of the SPV are sold, resulting gain is taxable in the hands of REIT. Resulting, this will not enjoy the pass-through status. Resulting gain is taxable only in the hands of the investment trust. Resulting gain is taxable only in the hands of the REIT. Okay, 111A and 112A are applicable. Okay, so it can be taxed at 15% if it is STT is paid. It will be taxed at 10% in excess of 1 lakh if LTCG is applicable. Okay, if STT is paid. Okay, if STT is not paid, it is sold towards not in a listed stock exchange, or it is shares of an unlisted company. Taxable at MMR. Taxable at all other incomes are taxable at wherever there is no special rate. All other incomes are taxable at maximum marginal rate. All other incomes are taxable at maximum marginal rate. Direct investment. If I directly invest in some properties, okay, rental income, okay, will enjoy pass through. That is taxed in the hands of unit holders. Any other income taxable in the hands of REIT and MMR. The same for investment trust also, with the difference that there will not be rental income.
Sir, one doubt.
Yeah.
Sir, if unit holders sell shares of business trust and they don't pay STT, even that is taxable at MMR?
For the unit holders.
Okay. So isn't MMR only applicable for business trust?
MMR is only for REIT, not for the unit holders.
Yeah. So if the unit holder sells the shares of business trust, what rate will it
For the unit holder, individual company yaru adu sollu.
Any that MMR will not be applicable for unit
The
holders.
MMR will not be applicable. Unit holder will be selling the shares and he will be computing LTCG or STCG and paying tax depending upon what status associate and what rate.
Yeah, so only if the business trust sells the shares, MMR will be applicable.
MMR will be applicable. That too of shares of unlisted company or shares on which STT is not paid.
Yeah, okay.
As a add-on to you, I'll answer one more. In the unit holder selling shares of business trust, அதுதான் இந்த amendmentல கொண்டு வந்தது ஞாபகம் வச்சுங்க. In the 111A, 112A, till last year, it was taxable without giving this benefit. Now, if the unit holder sells shares of the business trust, as I was telling, short-term capital gain or long-term capital gain will be STT paid 15% STCG, 10% in excess of 1 lakh LTCG. Remember, for business trust, they have not changed the holding period. The holding period continues to be 36 months. Now, bricks and metal, a REIT, registered under SEBI and classified as a business trust, provides you the following particulars of its income and seeks your opinion on the taxability. Okay, to ensure that I make the correction, I ensure that I give dividend two ways. Dividend received from non-SPV, dividend received from SPV where it owns 100%, interest received from SPV, interest received from debentures of unlisted company, STCG on shares and securities on which STT is paid, STCG on other investment on which STT is not paid, rental income, LTCG on shares on securities on which STT is paid, computed as per the guideline. Anupama, one of the unit holder of the REIT, received in total rupees 30 lakhs as distribution. This apart, in the previous year, she has sold the REIT, which has resulted in LTCG of 3,20,000. Specify the impact, income impact in the hands of Anupama also. Or even I can say, okay, not wholly owned SPV. In both the cases, the provision are going to be same. Because I'm making the correction, I want to make it twice or thrice. Okay, dividend received from a non-SPV or not wholly owned SPV. Okay, taxable in the hands of REIT. Provisions of section 1034 and 115 BBDA are applicable. Provisions of section 1034 and 115 BBDA are applicable. Okay, a paying entity is liable to pay DTT. Okay, the paying entity, be it SPV, not wholly owned SPV or non-SPV, they will pay DTT. Dividend received, okay, dividend received 21 lakhs, okay, less exempt under 1034 will be 1 lakh, okay, taxable under 115 BBDA will be 20 lakhs, okay, will be 20 lakhs, and you know the tax rate is 10%. Okay, you know the tax rate is as 10%. Dividend received from SPV, dividend received from wholly owned SPV, dividend received from 100% wholly owned SPV, exempt in the hands of REIT, paying entity is not liable to pay DTT. Okay, you are the last batch writing on this DTT, so be clear. Okay, paying entity not liable to pay DTT. Unit holder, when I am talking about Anupama, I will come. Okay, interest received from SPV. Interest received from SPV. Exempt in the hands of REIT, payer not liable to deduct tax. However, when REIT distributes the same, however, when REIT distributes the same, when REIT is distributing the interest, okay, tax needs to be deducted at source. Okay, 10% in the case of resident assessee and 5% in the case of NR, non-resident assessees. The TDS rate is because they are investing in infrastructure. Section 115A, which is taxing the non-residents, the rate itself is 5%. So here 5% deducted, 5% plus the HEC for 5% if it is deducted, and this is the only income of the non-resident. The non-resident is not even liable to file his income tax return. அது அப்புறம் பார்க்கலாம் non-resident detailed we'll do that, but okay, this is the provision for interest. So it is also, but it is taxable for the recipient. Okay, interest from debentures of unlisted company.
Sir, just one doubt.
Go ahead.
And the 115 BBDA la வந்து 10 lakhs exemption வராதா sir?
1 lakh போட்டேனா? Confuse ஆயிட்டேன் இதோட 112. Okay, interest from debentures. Interest from debentures of unlisted company okay, taxable in the hands of REIT at MMR, which is 30% plus 37% plus 4%. Okay, around 42.744. Okay, right? So it is 30%. Okay, on this 37%. Okay. Okay, on this 4%, 42.744. Okay, 42.744. Okay, taxable in the hands of REIT, maximum of everything. So 42.744%. Okay, so obviously exempt in the hands of the unit holder. Okay, STCG on sale of shares and securities on which STT is paid.
Sir?
Yeah, listening.
And the MMR la, isn't the on the trust yesterday you had said that surcharge is 12%. So
அதுதான் நான் வந்து இந்த மேவலையே கிளாரிஃபிகேஷன் கொடுத்தாங்க நம்ம ஆர்டிபிலயே. MMR means maximum of everything.
Oh, so even in the assessment of trust and the exit tax ku 37 vandrum, it won't be 12.
சொல்லிட்டு ஆனா this time in the November REI the November RTP they have put 12%. Okay, but the clarification is given. MMR means maximum of everything, maximum of rate, maximum of surcharge, maximum of HEC,
irrespective of the status. Irrespective of whatever status.
Irrespective of the status. Okay, it is maximum of everything. And one other clarification they gave is trust is falling under AJC, that is artificial juristic person, AGP. So it will come under the slab rates. அப்படின்லாம் clarification கொடுத்துட்டு, but this time when they saw the RTP yesterday, okay, they have put it as 12%, but MMR means maximum of everything. That
So we should
clarification
take 37 on it.
CBDT also gave, which was carried out in the institute material also later.
Okay, so we should consider 37 only.
37 only. For MMR rate is 42.744.
Okay, thank you, sir.
STCG on sale of shares on which STT is paid. Okay. Taxable under section 111A. Okay. 15%. Taxable under section 111A and the tax rate is 15%. Okay. STCG on other investment. On other investment. STCG on other investment taxable in the hands of REIT at MMR. Okay. It won't taxable in the hands of REIT. Okay, taxable in the hands of REIT at MMR. Okay, rental income. Okay, not taxable for REIT, not taxable for REIT. Payer not liable to deduct tax at source. Okay, while distribution, REIT deducts tax at source. While distribution, REIT deducts tax at source. While distribution, REIT is liable to deduct tax at source. LTCG on shares and securities on which STT is paid. LTCG on shares and securities on which STT is paid. Taxable in the hands of REIT. Gross LTCG is 9,80,000 less exempt 1 lakh. Okay. Taxable under 112A at 10% is 8,80,000. Okay. Taxation of unit holder. Taxation of unit holder. Are you there, Anupama? Okay. Taxation of unit holder. What Manas Anupama is not there? Anupama is a unit holder of the REIT, receives 30 lakhs. The first thing which we have to remember here, is the unit holder gets the income in the same proportion in which the trust has earned the income. The unit holder gets the income in the same proportion in which the trust has earned the income. Okay, so that is the crucial aspect here. Okay, so let us. I want you to understand this. Total amount received as distribution. Okay, total amount received as distribution 30 lakhs. Okay, total earnings of REIT. Okay, for a minute, my dear friends, 21 plus 16, 37, 37 plus 17, 54 plus 8, 62 plus 5, 67, 73.2, 90.2, 1 crore. Okay, 1 crore is the total earnings. Okay, 1 crore. Okay, 1 crore is the total earnings. Okay, total earnings becomes 1 crore. So the distribution will be in the same pattern. Dividend, okay, from a non-SPV, which is exempt in the hands of unit holder, exempt in the hands of unit holder. Okay, how much is that? 30 into 21 by 100. Okay, it is 30 into 21 by 100. Okay, 6,30,000 not taxable. This is exempt. This is exempt. Dividend from SPV, which is exempt, okay, under 1023, the subsection subclause, okay, FCAO, okay, so under section 1023, okay, ஏன்னா இது 1034 exempt சொல்லிண்டா 115 BBDA would have been applicable, but this is exempt under 1023. So the good thing
1023
is
FCA sir.
FCA தானே?
ஆமா sir.
Thank you friend. Okay, so the good thing now I am getting is I am getting the not under 1034 but under 1023. Okay, so again 30 lakhs into 16 by 100. Okay, this is also exempt for me. Okay, interest, okay, taxable. This is taxable, so I'll write the taxable in the next column, okay, which comes to 17. So 30 into 17 by 100. Okay, this is taxable in the hands of the unit holder. This is taxable in the hands of the unit holder. Okay, this is interest received. Okay, interest on unlisted debentures. This will not be taxable. This will not be taxable because already MMR is being paid. Okay, 30 into 8 by 100. Okay, this will not be taxable. Okay, yeah. STCG on which STT is paid. Already the trust has paid tax, so this will also be exempt. Okay. For this trust has paid MMR, so this is also exempt. Okay, rental income is taxable in our hands, in the hands of the unit holder only rental income is taxable. In the hands of the unit holder only rental income is taxable. So 30 into 17 by 100, 30 into 17 by 100, this is taxable in the hands of unit holder. LTCG, this is also exempt in my hands as the trust has paid the tax. Okay. Okay. This is the total. The exempt total comes to 19,80,000. and the taxable component come to 10,20,000. On the distributed amount, only interest and rental income are becoming taxable to me in the case of REIT and InvIT. Okay, other things, wherever the trust has paid the tax, it is exempt in my hands. The additional question that is asked is, okay, this apart, in the previous year, she has sold the REIT, unit of REIT, which has resulted in LTCG of 3,20,000. Okay, sale of units of REIT. Okay, taxable in the hands of unit holder. Okay, where it is sold through recognized stock exchange and STT is paid, 11A and 112A are applicable. Where it is sold through a recognized stock exchange and STT is paid, 111A and 112A are applicable. Okay. However, the holding period is, okay, 36 months and not 12 months. Just because STT is paid, don't think that amendment has not yet taken place, so it continues to be 36 months. Where it is not sold through recognize, okay, in fact, where STT is not paid. Where STT is not paid, section 1112 will be applicable. Or if it is STCA, normal rates. I think இதுதான் நீங்க கேட்டீங்கன்னு இல்ல திவ்யா.
Yes, sir. This is what I asked.
Yeah, somebody else was asking me a doubt. Question number 2. In the hands of various stakeholders, how will this be taxable? REIT dividend receives dividend from an SVV in which it does not hold 100%. Because I did not do it in class, I want to repeat it a couple of times. REIT pays interest on rupee denominated bonds issued to non-resident. Units are allotted by REIT to various company on transfer of their shares. Sale of shares by REIT other than shares of SP. Fine. Okay. Dividend from, okay, SPV which is not wholly owned. Dividend from SPV which is not wholly owned, taxable in the hands of REIT. Okay. Section 10 subsection 34 and 115 BBDA are applicable. Section 10 subsection 34 and 115 BBDA are applicable. Okay, payer needs to provide, needs to pay DTT, not taxable for unit holder. This is what is all stakeholders. Stakeholders are 3 people. That is the investing entity, the REIT, the unit holders. So stakeholders are three categories. So if they ask you to answer for all stakeholders, give the answer elaborately for each and every one. Okay. நிறைய பேசணும் நான் ரெசிடென்ட்ஸ்க்கு. Okay. Depends upon the one question which I am very much very confident about, which I am going to tell from top to bottom, the 12 items அப்படின்னு நம்ம பேச போகுது. IFSC, units located in International Financial Service Center, Gujaratல. I will give you all the 12 points there. Okay, அதுல RDB எல்லாமே கவர் ஆகும். Okay, so இப்போதைக்கு RDB issued to non-resident. Okay, interest on RDB issued to taxable for the non-resident at 5%. Enough changes are made in 115A. Okay, inge எழுதுறேன், but I will cover it. However, if the REIT is located in IFSC, okay, the interest paid is exempt in the hands of non-resident. We will talk about this. Don't worry. Now I have just written. Okay. Here there is no receipt for REIT. That's why the only stakeholder is non-resident. I have written. Units are allotted by REIT to various companies for transfer of their shares. கொஞ்சம் detailed அதுக்கு சொல்லிடுறேன். Okay. Okay, units allotted to various companies. Okay, right. Let us take X Limited in a real estate business. They are a construction company. They are in real estate business. REIT intends to make X Limited as an SP. REIT, what REIT want to do? REIT want to make X Limited as their SP. SPV now I should hold 50%. Okay. REIT will acquire shares of X Limited from various shareholders. Okay, REIT will acquire shareholders. In this case, I assume it is a company. Okay, X Limited is held by Y Limited. Okay, so which can various shareholder, which can also be company. The question is specific to company. I have written this because of one reason. Units are allotted to REIT to various companies. So to make X Limited as SPV, what should I do? I should acquire the shares. Minimum I should hold 51%. So I should go and acquire the shares from the shareholders. Shareholders are also company. Shareholders are also companies. So I acquire shares from them. Okay. As consideration, units are allotted to them. As consideration, I am not giving monetary consideration. I am giving my units, the units of REIT. Repeating. Okay. Y Limited is a shareholder of X Limited. X Limited being a real estate company, a REIT is interested in acquiring X Limited. So they approach Y Limited and say, transfer the shares to me. Transfer the shares of X Limited to me. As a consideration, I will allot unit of my company, of my trust. This is not regarded as transfer. So capital gain will not arise. The simple thing here is this transaction is not considered as transfer. this transaction is not considered as transaction. So if by the 47, in the language of 47, if I have to tell how to tell transfer of shares, okay, in consideration of units allotted by REIT, will not be regarded as transfer. Will not be regarded as transfer. When the units are subsequently sold, capital gain will arise. Provisions are same. Cost of purchase will be cost of purchase of shares, holding period, sale through exchange, non-exchange, அதெல்லாம் விட்டுறலாம். That is remember. Okay, where I want you to remember is, why is this transaction not taxable? Because, okay, REIT makes want to. So REIT purchases shares, in turn monetary consideration கொடுத்துட்டா taxable, in turn they allot units. This will not be regarded as transfer. This will not be regarded as transfer. Where I am trying to link this is, இன்னைக்கு night பார்க்கும்போது we will see, okay, what is the, okay, notional loss arising from transfer of unit, notional gain arising. So என்னுடைய shares, I am holding some shares and I am transferring it, that notional gain or loss, even though in books of accounts I am going to specify, it is not going to be taken at all. It is not regarded as a transfer. Simple provision only, but I want you to be clear, because many of you were asking me, what is this notional gain? What is this notional loss? Okay, I want to make it clear. That's why I gave it to you along with this example. Sale of shares by REIT other than, okay, okay, right.
So this transfer of units to various parties is not only companies, for all it is
All
not
of us,
considered
yeah.
as
All of
transfer.
us. It's a open provision. It's not restrictive provision. It is affecting 115 JB, so I took the control. Okay. Alternative investment fund. Here we have seen this amendment, but I want to once more recreate this amendment. Losses of investment fund. Provisions till financial year 18-19 is that investment fund na category 1 and 2 of alternative investment fund in the venture capitals, okay, middleman investment funds ellame pass through entities. Okay, provisions till 18-19 is that business income is taxable in the hands of the fund, and any other income will enjoy a pass-through status, that is taxable in the hands of unit holders. Losses will not enjoy pass-through status. This provision stands amended. This loss provision. Losses will also pass to the unit holder, provided the unit holder holds these investments for a period of 12 months or more. Accumulated losses as on 31st March 2019 will also pass to the unit holder, who can carry forward and set off over the remaining period to be completed from the year of loss. Unit holder will have the benefit of set off only if he holds the unit for a period of 12 months or more. Okay. That can be a questionable area because it's an amendment. An alternative investment fund registered with SEBI provided you the following details for the financial year 1920, specify the tax impact. Business income 34 lakhs, short-term capital loss 19 lakhs, long-term capital gain 21 lakhs, income from other sources 11 lakhs. The investment fund has a brought forward loss of 14 lakhs and long-term capital loss of 9.8 lakhs. allow me to just take the answer from here instead of typing. Okay. The next is securitization trust. Okay. Okay, this is also a pass-through entities. Okay, this is basically for the debt restructuring Sarfasi law provides. Okay, the law specifies that any income of security trust is exempt in the hands of such trust, but taxable in the hands of unit holder as if it is directly invested by the unit holder. The law specifies any income of the trust is exempt in the hands of the trust but taxable in the hands of the unit holder. The nature of income in the hands of the unit holder, like business trust, is in the same proportion in which the trust earns it. Income is taxable in the hands of the unit holder in the year in which it is credited and not in the year of distribution. Hence, where distribution precedes credit, then it is taxable in the year of distribution. So, whichever is first. Okay, right? These are all the tax rates which are applicable. So it is only taxable in the hands of the unit holder. Okay. Whatever you have studied, REIT, investment trust, securitization trust, even the moon payme, they have to file 2 returns. In penalty, I will tell you if there is a delay. Okay, all the 3 entities, securitization trust, REIT and investment fund. Normally REIT can be questioned. This time investment fund can be the question because of amendment, but normally REIT will be the question. Okay, so in the moon entity code, okay, administrative requirement of all the 3 entities. Okay, statement to be provided to the unit holder on or before 30th June. Okay, for because namakku July 31st da filing due date. So I should know in what proportion I have received. Okay, in the question we said Anupama received 30 lakhs. How she will know what goes to STCT, what goes to dividend, what goes to interest, what goes to rent? So the entity, be it securitization trust, investment fund, or REIT, has to provide to the unit holder a statement before 30th June showing the various split of their income so that it is taxable in their hands in the same proportion in which they have received. So before 30th June, statement has to be filed with the department on or before 30th November. Okay, statement has to be filed with the department on or before 30th November. They need to file the statement. These 2 are mandatory. Okay, all the 3 has the same principles, okay, or has the same methodologies. So these 2 are mandatory. If not, there is a penalty. I will check in the penalty section. Okay, so business trust can be a question. Twice they are asked on business trust. It can be a question, or it can be an adjustment from the business trust. I received this. Okay, it can be so. Investment fund, most probable questionable area, if not in the main, at least in the MCQ, loss பத்தி கேட்கலாம். Okay, remember 12 months hold பண்ணா இந்த loss எடுத்துன்னு வரலாம், then they can. Okay, the business loss alone now is there in the investment fund. Okay, they will use the word alternative investment fund. They will use category 1, 2, 3, 4. Don't worry about it. If they use the word alternative investment fund, go ahead and do that. Securitization trust is in the same Sarfasi register பண்ணிருப்பாங்க or SEBI directly debt recovery mechanism, that is, okay, and the unit holder will, all the incomes pass through to the unit holder, and it will be in the same proportion in which it has been earned by the person, by the trust. Okay, all these things have these two administrative provisions. Okay, with this we will end the morning class. I will meet you in the evening. Okay, I will meet you in the evening, 6 o'clock, where our discussion is assessment of companies. But before that, நீங்க ஒரு வாட்டி இந்த மேட் ஃபார்மேட்டை பார்த்துன்னு வந்துருங்க. 115 JB. I will not spend so much time in the format. Okay, format is already there. I will tell you how to remember the format. Okay, right? We will go to the small amendments. Section 79 la or amendment irukku, that is carry forward of losses for startup entities. Okay, I want you to just check on that amendment once. Okay, and things, and we will, by tonight when you are going to bed, we should ensure that I am very clear about PGBP. I will never touch PGBP. I am very sure about PGBP, and up to assessment of companies, whatever we have done, we will be very sure about it. So that tomorrow morning, we suppose if there is a spillover, because assessment of companies I have loaded a bit. Okay, suppose if there is a spillover, then we will do small part tomorrow, and I want my focus for tomorrow morning is that 8 marks of TDS. Okay, where we are going to make it. Meet you in the evening 6 o'clock. For all those people who have a doubt, please stay back. I'll answer that.